Sprouts stock has fallen by 39% over the past year, while their free cash flow has grown at a 10-year annualized rate of 19.3%. And better still, Sprouts is trading at a trailing PE ratio of just 15.7, which is a significant discount compared to their 5-year average PE of 20.4. But has the market mispriced Sprouts stock, or are there valid risks worth avoiding? This video will be an in-depth analysis of Sprouts stock, covering business operations, fundamental, and technical analysis. Sprouts is a domestic grocery store chain founded in Arizona that operates in nearly half of the states in the U.S. They're predominantly focused on providing fresh food, with 57% of their revenue coming from perishable products. Sprouts is a relatively small grocery store chain, currently operating 481 stores, which is fewer than their two main competitors, Trader Joe's and Whole Foods, with Trader Joe's having 608 stores, while Whole Foods has 530 stores. Now let's cover the macro-level pros of Sprouts' business. The most obvious advantage to Sprouts' business is that they sell essential goods, food, which is especially advantageous in today's economic environment, as consumer power seems to be ever weakening, partly thanks to inflation. Better still for Sprouts, in a time when so many retailers and businesses are being disrupted by some sort of innovation or Amazon, grocery retail seems like one business that will be minimally impacted by these changes. Another tailwind for Sprouts over other grocery store chains is that Sprouts provides healthy foods, and health is trending in the United States, with food preferences like being gluten-free, vegan, or consuming minimally processed food. Since 57% of Sprouts' revenue comes from perishable products like leafy greens, fruits, and vegetables, Sprouts is suited to and already has been capitalizing on these health trends. Speaking of Sprouts' revenue being predominantly from perishable goods, this means that Sprouts' revenue is more likely to be recurring, since perishable goods expire and can't be stored indefinitely, like canned goods or chips, for example, which may sit on a shelf or in a pantry for years. Yet another win for Sprouts is that their store count is growing extremely rapidly, with a store count growth of 41% since 2020, going from 341 stores to a current store count of 481. Which appears to be more store openings than Trader Joe's and Whole Foods over the same period. Although the store count figures from Trader Joe's and Whole Foods come from less reliable sources than the true store count numbers from Sprouts' annual reports. With Sprouts growing so quickly, this indicates that their business model and grocery store experience is being well adopted by their customers. And this is the foundation for why they are growing in store count. The last major advantage to Sprouts' business is that it's simple and easy to understand, which I think leads to being able to sleep well at night as a shareholder and counteracts the potential of selling shares at an inopportune moment due to a lack of understanding of the business. Sprouts looks to be a pretty solid business, but there are a few risks to consider. Possibly the most prominent being that they are attempting to take market share in a well-saturated market, since there are already grocery stores everywhere throughout the U.S., and there is strong competition with larger grocery store chains within their grocery store subcategory and in the broader grocery store segment in general, like with Walmart, which is the nation's largest grocer and operates 4,850 stores and has already established itself in every corner of the U.S. Furthermore, the grocery stores that Walmart operates offer more products and products that Sprouts doesn't offer, like Tide detergent, for example, and many other products and brands that are sometimes sought after, which is due to the fact that Sprouts has decided not to offer particular brand names based on their core values. So Sprouts has a bit of a niche customer base and niche inventory. Another negative to Sprouts' business is that they don't own any of their stores. They only lease them, and leasing stores means they're likely locked into rent escalation in perpetuity, while store ownership would negate these perpetual rent escalations. That's all I could think of for the business cons. Let me know in the comments if you think I've overlooked some negative elements of Sprouts. Now let's get into the foundation of the business, starting with revenue. Sprouts' revenue has grown quite well over the decade, almost each year, growing from just $3.6 billion in 2015 to $7.7 billion as of 2024, giving Sprouts an annualized growth rate of 8.0% over the decades. And unlike many businesses I've seen lately, their growth has been accelerating in recent years, which makes the recent sell-off even more enticing. If we look at free cash flow per share, growth is even better than revenue, having a mind-blowing 10-year annualized growth rate of 19.3%, which is incredible and dramatically outpaces some tech companies like Microsoft, for example, with a free cash flow growth rate of 11.8% over the same period. Better still, Sprouts is buying back shares at a rapid pace, with an annualized share count reduction of 4.3% from 2015 to 2024. So shareholder value thus far has just been pushing higher and higher, but what about their liabilities? They have a current total liabilities level of $2.6 billion, and their liabilities have been growing fairly quickly over the decade. And if we add back their cash on hand at $322 million, their true liability level is at $2.3 billion, which is only 4.4 times their trailing 12 months net income, which is quite low for almost any business, and yet another positive note for Sprouts. If you like seeing these line items clearly laid out, like net income and total liabilities, I have a link for Seeking Alpha that will give you a discount in the description below. In terms of valuation, Sprouts is trading at an objectively low multiple, at a trailing price-to-cash flow of just 11.2, which is oddly not far off the 5-year average price-to-cash flow of 12.6. Or if we use the trailing PE ratio currently at 15.7 compared to Sprouts' peer group using the Consumer Staples ETF, XLP, at a PE ratio of 23.2, Sprouts looks to be trading at a significant value. One final way we could value Sprouts while accounting for their fast earnings growth rate is by using the PEG ratio, which again indicates serious value to be had at a PEG ratio of just 0.32. Here we see a 5-year price chart for Sprouts, and over this period, Sprouts has had a phenomenal, market-beating return of 299%, and the price trend is still clearly moving upward. Next, the standard deviation channel shown here with these yellow channel lines shows us that Sprouts is significantly discounted compared to its own 5-year average price of $132, indicated with this center yellow line, while the current price is at $81, which is a sizable 39% discount compared to the average price. In terms of support and resistance, price looks to be respecting and holding this price level at about $75, and the next prominent resistance level I see is quite a bit higher, around $98. Lastly, we have the Relative Strength Index, or RSI, graphed at the bottom of the chart, which again shows current value and potential for upside, with the signal line being at the bottom of the channel, at a level of 29. And even better, it's near a 5-year low, indicating the stock is oversold. That's all for today's video.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.